In today's episode, I'll talk about two stories. In the first one, I'll talk about how a $22 billion port deal in Panama has turned into high-stakes power struggles between the US and China. And in the second story of the day, I'll talk about how India's biggest port operators are very quietly now transforming into full-stack logistics giants. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Friday, the 20th of June. See, I'm sure all of you know about a shortcut to the world that is so valuable that it moves over 400 million tons of global cargo every single year. It's called the Panama Canal, and it is a single lane of water that largely powers global trade by connecting the Pacific and the Atlantic Oceans through the middle of Central America. And right now, it is in the middle of a $22.8 billion deal, and while it may look like a regular business transaction on the surface of it, the truth is that beneath the surface, it is actually becoming a serious geopolitical power play. So the story largely revolves around two ports. Now these ports sit at either end of the Panama Canal, and they act as entry and exit points to one of the most important maritime routes. And together they handle nearly 39% of the canal's container traffic, which is about 37.4 million TEUs or 20-foot equivalent a year, and they manage more than 12,000 ships annually. Now they are also deeply tied into the canal's core function, which is transshipment. Basically, cargo from large ships are unloaded at these very ports, and then they are redistributed via smaller vessels to ports that are across Americas. And all of this makes them critical nodes in both global and regional trade. And guess what? Now they are up for sale. And the buyer is actually a consortium led by Terminal Investment Limited, which is the port operating arm of MSC, which is the world's largest shipping company, and also BlackRock's global infrastructure partners. The seller is CK Hutchison, which is a conglomerate based in Hong Kong. And the proposed price tag is no small figure. Like I said, it is 22.8 billion US dollars. But that said, the deal is not just about these two ports. If it is approved, MSC and BlackRock will also gain minority stakes in 41 other port-related assets across Panama, which include rail links, logistics parks, and also valuable land parcels. And that would essentially give them outsized control over broader infrastructure ecosystem that is surrounding the canal. Now, Hutchison would retain only a small residual stake, and that's where things get a little complicated. That's because this is not really a commercial handover as such. It's actually a shift in who holds influence over one in the world's most important choke points. And in case you're wondering, by the way, the Panama Canal is much more than just a regular trade route. It's actually a lever of global power. It allows ships to bypass the long and more expensive journeys around the southern tip of South America, which basically cuts weeks of shipping times and also saves millions of dollars in fuel costs. So if you are transporting goods from, let's say, Japan to New York, or even between the east or west coast of the US itself, that particular canal is your fastest option, hands down. And therefore, it's always in high demand. To give you a quick reference, around 5% of global maritime trade passes through this very canal. But that said, as valuable as the canal is when it works, it's also a huge vulnerability when it does not. And that is exactly what happened in 2023 when a severe drought reduced water levels, and it forced authorities to cap the number of ships that were allowed to pass every single day. And the result was a shipping traffic jam. There were long delays, and there was a spike in freight prices. And on the flip side, when trouble hit the Suez Canal earlier this year, all thanks to tensions in the Red Sea, cargo from Asia to the US East Coast had to be rerouted through the Panama Canal itself. That basically became a pressure valve of sorts for global shipping. Now, these movements basically reveal one simple truth. The Panama Canal is a very big choke point. And choke points by nature are points of leverage. And that is why this deal has become so politically charged right now. See, while the canal itself remains under Panamanian control, the two ports that I spoke about in the beginning give access to it. So whoever controls them actually ends up gaining influence over what comes in and out of the canal. And that can be used directly or indirectly to shape trade dynamics. Now, historically speaking, Panama has always attracted outside interest because of this very canal. It was never really a local project as such. It was first conceived by the French and it was then taken over and built by the United States, which ran it for over 80 years. America also set up military bases around the canal, making it very clear who controlled the gateway between the oceans. Now that began to change in the 1970s after tensions between the US and Panama boiled over. See, eventually these two countries signed the Torrijos-Carter treaties, which promised Panama full control over the canal by 1999. But that came under one condition: the canal must always stay open to ships from any country, even during the times of war. But that shift was not peaceful. In 1989, the US invaded Panama, citing self-defense. Now, one of its key objectives at that point in time was to safeguard its control over that particular canal. But ever since then, Panama has maintained control. But that said, the fight for influence never really ended. It just moved behind the scenes. See, over the last decade or so, China began courting Panama as part of its Belt and Road Initiative. Relations between these two countries started to warm up very quickly, and in 2017, Panama ended its diplomatic ties with Taiwan and formally recognized China. And a year later, it also joined the Belt and Road Initiative. And at that time, China's state-linked companies began expanding their footprint in Panama, and Hutchison's 25-year lease over the two ports was renewed in 2021. But that momentum, mind you, did not last very long. When Donald Trump took over office in the US, Washington began pressurizing countries like Panama to roll back their ties with China. Eventually, Panama exited the Belt and Road Initiative, and that shift in loyalty set the entire stage for the deal that we are seeing and talking about today. Now, to China, this sale looks like Western encroachment, which is a strategic push by American aligned firms to gain control over a very important point of maritime power. Now, Chinese media and government-linked voices have framed the deal as a loss of critical infrastructure, and Beijing is now working very hard to derail it altogether. Some reports also suggest that Chinese authorities are pressurizing CK Hutchison to pull out of the deal, and they may even use antitrust or national security laws to do all of this. The final approval now rests with Panama's Maritime Authority and the Panama Canal Authority, both of which are under heavy diplomatic pressure from both of the sides. There is one more twist though. Leaked reports indicate that China's state-owned shipping giant COSCO is in advanced talks to buy a small minority stake in the MSC-led consortium. Now that could be a very interesting way for China to reinsert itself into the port's governance, even if it manages to lose majority influence. Now that is basically an attempt to ensure that it does not get entirely cut out of the picture. Why does it matter so much, you might be wondering? That is because in the world of trade, influence is not always loud or obvious. A port operator can very subtly sway everything, right from ship schedules to terminal fees to even cargo processing speeds. They can make life easier for some players and very quietly harder for many others. And all of this happens within the bounds of neutral commercial operations. In a more extreme case, the ports could be used to collect intelligence, to track cargo movements, or even interfere with rival supply chains through digital infrastructure. And so, what we're watching today is more than just a simple business deal. It is a very quiet realignment of power. Because if the sale goes through, it will completely shift the balance of influence over one of the world's most vital arteries. To Washington, that's definitely a win because it's a chance to push China out of its own backyard. And to Beijing, it is a strategic loss. And stuck in the middle of these two is Panama, which is sort of trying to walk a tightrope between two giants while it is holding on to the canal that makes the country matter in the first place. That brings me to the end of the first story. Let's now move on and talk about the second story. In our previous story, we had looked at India's ports industry and its crucial role as the lungs of our economy. To give you a quick gist, the vast majority of the goods that we bought and sold as a country, 90% of the volume in fact touched our ports at some point in time. But the thing is, knowing that ports matter is just one thing, but understanding the actual business that runs them is quite another part of it. So like we promised last time, we are now diving into two companies that sit behind the scenes as cargo moves in and outside of India. These two companies are Adani Ports and JSW Infrastructure. Now these entities are at a very interesting juncture, and that's exactly what I'll talk about in a bit more detail in today's story. I'll talk about how these players are not just running ports anymore, they are actually building something that is much more ambitious. Let's start with Adani first. See, Adani Ports and Special Economic Zone Limited, or APSEZ, is India's largest private port operator. It runs 15 ports and terminals across the Indian coastline and captures 27% share of all the cargo that is handled in our country. Adani's flagship port, which is Mundra in Gujarat, is now the first port in India to cross 200 million metric tons or MMT in a year. Now that of course is very impressive in itself, but the truth is that it just scratches the very surface. See, Adani is in the process of entirely rewriting its entire business. See, for decades, port operators made money in a fairly straightforward way. When a ship arrived, they charged for letting it dock. When cargo needed unloading, they charged for that. And maybe sometimes they would also store some containers for a few days and they would collect storage fees. Now this was basically a volume game. The more ships that came in, the more money you made, and your fortunes obviously rose and fell with global trade cycles. But about a decade ago, APSEZ started thinking about this slightly differently. They began asking, why only touch cargo when it is at the port? Why not control its entire journey end to end? Now think about what happens when a container arrives from, let's say, China, for example. First, it gets unloaded at the port. Then a truck picks it up and takes it to the railway yard. Then a train carries it to an island depot. From there, another truck takes it to a warehouse, and eventually yet another vehicle delivers it to its final destination. It could be maybe a factory in Haryana or a distribution center in Pune. Now here is what it really looks like. At each step, different companies handle the cargo and each one takes their own individual cuts. But what if one company could do all of it? That is exactly what APSEZ is trying to do. They basically started expanding beyond the waterfront to buy their own trains, 132 rakes to be very precise with you. They also built inland logistic parks in cities far away from the coast and set up 3.1 million square feet of warehousing. And at the other end, they acquired a fleet of 115 vessels for marine services. And they even created tech platforms to manage trucking and freight forwarding. So if you think about it, a company that once used to just run ports is now very slowly turning into what they now call an integrated transport utility. Now, in the words of Mr. Divesh Taneja, who is the CEO of Adani Logistics, I quote, "You're seeing us move from custodians to exhibiting control over cargo." Now, the financial logic behind this transformation is also fairly intuitive. Let's say unloading a container earns you, let's say 100 rupees. That is basically the amount of money that a traditional port operator would make. But if you also move that container on your own train, you store it in your own warehouse and you deliver it using your own trucking network, you could earn, let's say, 500 rupees from the very same container. Basically, more touch points mean more revenue and, more critically, higher margins. You can see this shift in their numbers as well. In FY 2025, Adani ports handled 450 million metric tons of cargo, which is about 7% more than the previous year. But their revenue, interestingly, jumped 23%, while their profits actually surged 50%. The question then is, of course, how does a 7% growth in volumes translate to a 50% profit growth? That is the story of Adani's changing business model. There are three things that are largely driving this transformation. First, the type of cargo is shifting. We spoke about this yesterday as well. See, as our economy grows more sophisticated, containers which carry higher value goods like electronics, textiles, or auto parts are growing faster than bulk cargo like coal or iron ore. Now that is what Adani is seeing. Containers now make up 45.5% of Adani's total cargo, which is up from about 44% 1 year ago. And because container cargo involves more steps in the supply chain, it usually offers more opportunities to earn revenue as well. Second, its non-port businesses are also taking off, and that is the shift I was referring to. Adani's logistics arm grew revenue by a massive 39% to around 2,881 crore rupees last year. Marine services, which include things like dredging harbors, supporting offshore operations, and guiding ships, grew even faster and jumped by an incredible 82% to about 1,144 crore rupees. So what used to be a side business is now, in a sense, becoming a major revenue driver. Third, they are getting better at squeezing profits from existing operations as well. See, even with modest volume growth, they have expanded margins through smarter pricing while also controlling costs. Now, equally, the company is focusing on making sharper investments that generate quicker returns as well. Their domestic ports, in fact, are returning all the capital that they have invested in less than 5 years, which is in an industry where returns would have previously come in as long as a decade. Also, very impressively, these improvements in their business have coincided with them slashing down on their debt as well. To give you a reference, their net debt relative to earnings has fallen from 2.3 times to 1.9 times over the last 1 year. They repaid 5,500 crore rupees in debt last year, and they ended with nearly 9,000 crore rupees in cash. Their future investments, which are slated to be at around 11 to 12,000 rupees next year, will come almost entirely from their own profits and not really any new borrowing. Anyway, one more interesting thing here is that Adani's ambitions are not just limited to India. They have also been building an international network over here. For one, they run Haifa port in Israel, which obviously many initially thought was a risky bet given the region's tensions, but Adani has actually managed to stabilize those operations. They have signed long-term union agreements and they are now seeing double-digit profit growth. They have also started operations at a terminal in Colombo, Sri Lanka, have won a 30-year concession to run a port in Tanzania, and they are acquiring a major coal terminal in Australia that could handle 50 million tons annually. Now, this international expansion is sort of like an insurance policy for their business. It basically allows them to diversify their bets in a heavily capital-intensive sector. So basically, if India's trade slows down due to a recession or policy changes, having ports in other high-growing regions provides stability over here. Now that said, that was all about Adani. Like I said, there is one more player, JSW Infrastructure, which is India's second largest private port operator that is also doing something very interesting. See, at the end of FY 2025, the company had 177 million tons per annum of operating port capacity, which is across 10 ports and terminals strategically located on both the east and the western coasts of India. Now these ports, mind you, are not just piers and cranes. Many are deep draft facilities which are capable of handling larger ships as well. Right now, JSW Infrastructure is taking an approach which is very, very different from Adani's, but that said, it is equally interesting. They are planning on becoming a full stack logistics enabler for heavy industry. I'll explain this. See, while Adani is building a global multimodal network that can handle any type of cargo, JSW Infra is actually sharpening its scope instead, and they are focusing on becoming the go-to logistics partner for India's heavy industries. And that is why, unlike Adani Ports, which is by the way slowly moving towards containerized cargo, the strength of JSW's infra ports lies in bulk cargo, which are things like coal, iron ore, and liquid cargo. And by the way, if any of all of this sounds alien to you, you might want to check out yesterday's edition for some added context. Anyway, back to the story here. What distinguishes JSW's business is their integration with all of this. See, many of JSW's ports are actually connected directly to steel plants, power stations, and also mined through dedicated rail lines, and also interestingly, slurry pipelines. I'll explain this as well. Imagine you're in the business of exporting iron ore, but you do not have to load it all onto trucks which drive all the way to the coast, which kills your already razor thin margins. What if instead you can actually grind it into fine powder, mix it up with water, and pump it through a 302-kilometer pipeline to the port directly? Now that sounds absurdly weird, I know, but that's exactly what JSW is building in Odisha. And that, mind you, is one of the most efficient ways to move bulk materials over long distances. And this very tight integration also creates consumer stickiness for them because consumers' operations are now built around the infrastructure that JSW provides almost end to end. For instance, imagine you're running a steel plant. If your coal arrives at a specific port and your iron ore comes through a particular pipeline, then your entire operation, largely speaking, is designed around your logistic provider's network. So switching to someone else at that time would mean rebuilding everything almost from scratch, which ideally you would want to avoid unless you're doing something absolutely necessary. Now, JSW has built the network out in the very recent past. They had started out by serving only their parent company's steel and power plants, but today half their cargo actually comes from outside customers who have built their operations around JSW's infrastructure. And the company's fourth quarter results also show how this model is working out for them. See, over Q4 last year, their revenue grew about 5% to 1152 crore rupees. But the company's net profit for Q4 had jumped 57% to 516 crore rupees. Now, one thing to note here definitely is that operating profits of the company were nowhere as impressive. The company's EBITDA for the quarter grew by a far more modest 8% to 626 crore rupees. Some of the profit actually came from one-time currency gains, while the company essentially had to tax outgo over the last quarter. But regardless, the underlying business is clearly strengthening here. The company is bringing in more capacity online with about 1 million tons of new capacity coming up over the quarter. Now, this is slated to grow over the coming quarters as well. And the company is ramping up capacity of its existing ports as well. To give you a reference, at Southwest Port in Goa, the company has expanded from 8.5 to 11 million tons per annum. It's also in the process of getting regulatory approvals for a further expansion of all the way up to 15 MTPA. And meanwhile, JSW Infra is expanding beyond ports as well. They recently bought 70% of Navkar Corporation, which runs inland container depots at freight stations. Here, containers can be sorted, stored, and distributed en route to whatever destination it finally must get to. It's basically one more way to capture more value from each and every single shipment. So basically, all said and done, what we're witnessing right now with both of these companies is a very fundamental shift in how the logistics business works in our country. The old model was simple, like I said, you owned a piece of key infrastructure and you used to charge tolls. But these very players are now thinking about owning the entire journey. And this transformation matters for several reasons. For starters, their customers need to deal with fewer vendors while they also get more predictable services. And for these companies, on the other hand, it means higher margins and also more stable revenues. And for India's economy at large, it means more efficient trade infrastructure which can handle growing volumes without proportional increases in costs. That brings me to the end of the two stories of the day. On that note, let's move on and talk about the quick news headlines. First, Dassault Aviation has announced a significant expansion of its joint venture with Reliance Aerostructure Limited at the Paris Air Show, which marks a first in Falcon jet manufacturing outside France. The Dassault Reliance Aerospace Limited facility in Mihan, Nagpur, which is already responsible for delivering more than 100 major subsections of the Falcon 2000 since 2019, will now be upgraded to a center of excellence. Second, Wellcure Drugs and Pharmaceuticals Limited has signed a 517 crore rupee third-party sourcing agreement with Thailand-based Fortune Sagar Impex Company. Under the X-Works model, Wellcure will earn a fixed 5% commission on the transaction value, translating to an expected service income of 26 crore rupees in FY26. Third and the final one for the day, India's clean industrial transition faces a critical slowdown as only 1 out of 41 announced projects worth a cumulative $89 billion has reached final investment decision in the past 6 months. Despite a strong pipeline in sectors like green ammonia, hydrogen and sustainable aviation fuel, just about $13 billion has been committed so far. In comparison to global figures, 83% of the 826 clean industrial projects worldwide are still awaiting financing, which highlights a broader investment challenge. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and goodbye. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.